To get started. Oh, actually, Paul, if you can flip back one slide.
Okay, there we go.
Perfect. Well, in 3, 2, 1. Welcome everyone to session number 9 of the Succession Matching Community Project. It's my pleasure to introduce Paul. Succession Matching's worked with Paul for a number of years on chartered business valuations. We find that they're very important for two reasons on both the buyer and seller side. The first is to get a general idea of what the business is worth, and the second one is to give some negotiating points that you can use when you're talking to the other party. So without further ado, I'd like to turn it over to you, Paul.
Thanks, Alison. So we'll get straight into the agenda. The first thing I'd like to talk about is whether or not you really need a third-party valuation. I find that particularly with a lot of small businesses, there is some resistance to this idea. So I'm just going to cover a few things to think about. And then we'll go from there looking at your financial history. I want to spend a little bit of time on understanding value, what it really means. And then we'll look at some valuation methods and a couple of other things like reasonableness testing and some common areas. Those are the areas that I want to spend the most time on. But if anyone has any questions during the presentation, please feel free to just fire away. So getting on to whether or not you really need a third-party valuation, I think the thing to keep in mind here is the reason why you are, or what the purpose of the report would be. There's a number of areas where reports are prepared. The one that we're dealing with was with business purchases and sales. We also look at succession plans involving family or employees. Reorganizations is an area I do a certain amount of work on. That usually requires quite a lot of work and needs a single result. Disputes, that's another area I do quite a lot of work on. That's shareholder disputes, marital disputes, and so on. That usually ends up in court in some way or another and requires quite a lot of work. And then public company reporting is an area I don't do much work on, but it is an area that some valuators look at. So the questions that you should be asking really are, how will you determine the value of your business? Who might challenge that value? And what are the stakes? And I would say that last question is probably the most important one. If the stakes are fairly high, then you really should get an outside party to help you with this. It just gives it a bit more credibility, gives you more confidence in the results. Looking at who might challenge the value, this is also important. And I mentioned that I do work in things like divorces and shareholder disputes. In those cases, they're usually fairly emotionally charged and very often are finally determined by the courts. What the judge is looking for is a single point and a third-party expert to report on that. Now, contrast that with the selling of a business. When you sell a business, what a third-party valuator will really do is provide you with a range within which you can negotiate. And the ultimate determinant of value will be in the negotiation. So when you're looking for a third-party valuation for the buying or selling of a business, what you really should be asking for is not a pinpoint accurate number, because that is usually very difficult or could be very expensive to get to. But ask for a range within which you should be negotiating. A sort of top end of the range, which would be, that's the price that you would do well to get. And the bottom end of the range should be the value at which you shouldn't really sell any lower than that. Oh, I see there's a question here, define the stakes. I really mean the financial stakes, but it could be emotional stakes. In buying and selling a business, sometimes there are a lot of emotions involved, because people who've built a business over a number of years may feel that it's worth a lot less than the value, or beg your pardon, may feel that it's worth a lot more than the valuator comes up with. But really, when you're buying and selling a business, it's best to try and leave the emotions out of it. And if you do think that the emotions will play a big part, then probably all the more reason to get a third-party person to help you. What's going on? Oh, sorry. I beg your pardon, that was my phone ringing here. So if we can carry on now to the next slide. This is dealing with the financial history. You know, your financial history is really important, and it is important to have financial statements, preferably for at least 3 years, but possibly 5 years. And your financial statements they really should be truthful and credible. That should really go without saying. But keep in mind that you're presenting information to people who could subsequently sue you if it is found that those statements are misleading. But they should also be sufficiently detailed to tell your story. So, you know, when you're planning to sell your business, sometimes it takes several years to get to the point where you can sell. Make sure that your financial statements are sufficiently detailed so that the person reading them gets the whole picture. However, what I often find is interesting is that people who are selling their businesses have this notion that their business is, the value of the business is connected to the level of sales last year. Level of sales last year, or the profits from last year, is not a bad indicator, but what you should really be thinking about is the value at the end of the day is forward looking. So when I'm valuing a business, I look at the projections and I look at what the business can achieve in the current economic environment. So looking forward about 12 months or so. And while that is informed by the financial history is by no means the full story. So I think you really need to just keep in mind that that it is the future that is important, and that stands to reason as well. Somebody buying your business is not really that interested in what it's done before, but what they really want to know is what it's going to do in the future. I see there's a question about getting audited financial statements. I don't believe that you need audited financials, and I don't often see audited financial statements in a buying and selling situation. I think the main thing is that they should withstand any scrutiny of any potential buyer. So, you know, make sure that they are truthful and credible and give the whole story. So getting on to understanding value, I think the key point to understand here is that fair market value, which is the measure of value that I always work towards, does not equal price. Fair market value is objective, it is fair, it is notional, and it's the same in all circumstances. But price, which is what you will ultimately settle for when you sell your business, is largely about the negotiation. It can start off with fair market value, but ultimately the price is determined through negotiation, and that negotiation may not be fair to everybody. So think of it a little bit like selling a house. You get an appraisal before you sell your house, and that's a good guide, but it's really a guide to the negotiation as opposed to being something that you absolutely have to achieve. So understanding what fair market value means, and if you're getting a third-party valuation, this is usually what they will work towards. And fair market value assumes that the market is fair. And fairness means that the transaction is open to a wide range of buyers, so it's not just the people down the street. The assets that you have in the business are being put to their best use. No one, neither the seller nor the buyer, is being compelled to transact for any specific reason that might color their view on value. We're assuming that all the parties are well informed and they're acting prudently. It's determined objectively. So if you're selling to your children, you might end up determining a price that is somewhat less than fair market value just because you favoring those children, whereas a valuator will be looking at it totally objectively, which means at arm's length. And the final point is that fair market value is expressed as a single lump sum. And quite often when a business is sold, it is sold over a period of time, and that might mean that the final price is somehow different to fair market value. And as I've said at the bottom there, these attributes may not exist in a sale transaction. Some of them might, but generally speaking, I think the key thing to remember is that fair market value is a very notional concept. The price is what you finally get for it, and very often that is anything but fair. And it's up to you to negotiate as best you can to get a deal that is in your own best interest. So just another point about understanding value, and value can really be reduced to two key attributes of the business. The first one is the opportunity that the business presents, and that's a reflection of the future prospects. The other key one that people often miss is the risk that is involved in the business. And when we talk about risk here, what we're really referring to is how certain is the future revenue and cash flow. And if you're in a business where the future revenue and cash flow are almost guaranteed because you have certain contracts that are going to be there forever, you've got very low risk. But if you are having to fight for every sale and you really don't know from 1 year to the next what your revenues and cash flows are going to be, then that is an indication that the risks are quite high. And there can be a lot of different reasons for that. Sometimes it's the people in the business. Sometimes it's the market you operate in. Sometimes it's political or geographical considerations. So, but keep in mind that risks are a big part of the overall value. So now I'm going to look at some of the valuation methods that are commonly used. The first one is the cost method, and this is the simplest method of all the valuation methods. Essentially what it does is it takes your balance sheet values and it just adjusts the value of the assets and liabilities on the balance sheet to their own individual fair market values. So a good instance would be a holding company that has real estate in it. The real estate might have been bought 20 years ago at, let's say, $1 million. That's still reflected on the balance sheet at $1 million less depreciation. you can probably get a property appraiser in who might, for example, tell you that that real estate is now worth $3 million. So what the cost method does essentially is it just takes the balance sheet and adjusts all the assets to their fair market value, recalculates the net worth of the company, and that then tells us what the overall value is. Usually there's no goodwill in this. When we use this method, it's because there isn't any goodwill, and typically it's used for holding companies, or when most of the value is in real estate, or there are high value assets that are not performing in the way that we would normally expect them to, which is an indication there won't be any goodwill. So just a quick example, I mentioned there assets at 5 million on the books. The fair market value adjustment takes those assets to 2 million, increases them by 2 million to 7 million. We've got a bunch of liabilities at 4 million. Usually, most liabilities are usually at their fair market value, and that would, excuse me, take the fair market value of the business to 3 million. Now, if you just look at take out that fair market value adjustment, we originally had 5 million of assets, 4 million of liabilities, which would have given the shareholder value on the balance sheet as being merely 1 million. What we've done now is we've got a fair market value of 3 million, which you'll see is the same as the fair market value adjustment on the assets. So a pretty simple method. The income method is a much more challenging method. Basically, we look at your cash flows or income, or EBITDA, which is earnings before interest, tax, and depreciation. And we use a capitalization rate that is suitable to the risk. This method calculates goodwill, and essentially what we do is we take the net cash flow, apply a capitalization rate, and we then get capitalized cash flows, deduct from that the value of the tangible assets at their fair market value, and that gives us a value for goodwill. Now, this method, it's typically used for operating businesses that are generating good returns, so there's an assumption that there is goodwill. But it also assumes that there is a fairly normal level of assets and liabilities on the balance sheet. And so part of the process of this valuation method is to look at what we call redundant assets. And this I show on this next slide. Redundant assets, it's a fairly technical term, but these are assets in the business that are not essential in the generation of revenue or profit. And what I often see is that businesses have a lot more cash on their balance sheet than they really need, or some aspects of working capital are more than what they really need. I also often see that the business has lent money to other people, and that's unnecessary for the operation of the business. Sometimes real estate is treated as a redundant asset simply because the risk in real estate is very different to the risks in the operations. And also what I do see from time to time is that because the company has very little borrowings, the company could in fact borrow a lot more money, use that money without any kind of disruption to acceptable working capital ratios. The value of the business might remain the same, but they could use that money to probably pay a dividend, which means that there's a kind of hidden value in this business which needs to be accounted for in calculating the fair market value of the business as it stands at the moment. It doesn't mean that that's what you will sell it for, more than likely what you will do is pull the value out of the company before you sell it. That also makes it more affordable for the buyers. Now, I see we've got a question here. Are there standard cap rates by industry region which you would start when computing value? Generally not. What I find is that capitalization rates are really a measure of the risk. And so while some industries have a range of risk that we would look at, and some industries are much more risky than others. So while there aren't really standard cap rates, there probably are some ranges that would be reasonable. But we need to keep in mind that the risks that I'm looking at are much more than just industry risks. It's related to the location of the business, the competition, the people that are in the business. There's a whole range, and so while those standard rates are sometimes I use them, and I'll get onto this a little bit later in the presentation. While we can use those as a kind of reasonableness check, I don't normally use those when I'm starting out. I usually try and value it from the ground up. So just looking at how the income method works in practice, and this is obviously very simplified. I'll calculate a maintainable free cash flow, which is basically what I think the business can do in the foreseeable future. Let's say I've worked out that the average cost of capital is 20%, gives us $10 million capitalized free cash flow. I'll have done my work to establish a value for redundant assets, and I've figured that's going to be $2 million. We deduct the long-term debt, and that gives us our shareholders' equity. Sometimes there are preferred shares, which means I then need to deduct those at their redemption value to get to the common share value. But typically in a buying and selling arrangement, most of the time, if the company is selling the assets of the business, the value at which they would be looking to sell this business would probably be that $10 million level up near the top. So the company would sell the business for $10 million. The company would then pay off its own debts and would be left with a bunch of these redundant assets plus a whole lot of cash. And then the company can decide what it does next. But if it's a decision that the shares of the company are to be sold and not the business sold out of the company, then we would typically look at that $5 million at the bottom. So calculating goodwill, we look at that capitalized free cash flow, look at the value of assets at $7 million, gives us that goodwill of $3 million. And this is really the number that we need to look at very closely and just to say, is that reasonable? And is that transferable to a new owner? And this is where a lot of work should be done in the actual sale transaction to make sure that that goodwill is properly transferable as far as possible. Some of it will be personal to the owner and it cannot be transferred, but some of it is a question of just structuring the transaction in such a way that that goodwill can be transferred. Moving along, the market method, and this is where we look at some of these standard multiples that were referred to in that earlier question. And this is where we would use standard multiples that have been reported by other businesses in a similar industry. And what we'd be doing here is applying these multiples to a measure in the business. So we'd say, okay, it's capable of gross profit of X amount, and we know that other businesses that have sold for a multiple of gross profit. And so that's what we would use to calculate the value of this particular business. I find that it's only really useful as a primary valuation method if the businesses are kind of cookie cutter type businesses. And that's, things like a, Tim Hortons franchise, where all the metrics within the business are the same regardless of where it is. I do use this as a reasonableness test for, more complex valuations. But the thing we have to keep in mind that it is difficult to find truly comparable businesses, and so the multiples can vary a lot. Typically what I do if I'm using this as a reasonableness test is I grade all the multiples for other businesses into their different percentiles, and I then look at my conclusion and try and figure out whether my conclusion positions the business at a percentile that makes sense. In other words, we all know that it's a much better than average business. Therefore, we would expect it to come out at the multiples that are suitable for companies at, say, the 75 percentile. So just a very simple example, using EBITDA and a multiple of 2.5, we'd arrive at a value of the business that is going to be sold, deduct the liabilities, and that gives us the fair market value of the company. But as I say, we need to be really careful about using these kind of metrics. And I realize we are getting close to our allotted time, but the questions that should always be asked, and these I think are the ultimate test of the valuation conclusion. What is the overall payback period? Does that make sense that the new owner is going to spend 5 years or whatever it is to get their money back? But more importantly is, what is the payback period for the goodwill that we've calculated? Because at the end of the day, if the business fails, we can always sell off all the assets and the only real loss is the goodwill. So it's good to look at what the payback period is for the goodwill. Some common areas, I'm just going to run through these fairly quickly, and I think you'll get these as a handout, so you can go through these at your leisure. But assuming one size fit all, that was alluded to in one of the questions. Capitalization rates that are inconsistent with the cash flows to which they're applied. Incomplete normalization, so not really accounting for the fact that the owner's wages might be incorrect or inadequate. There's an inadequate analysis of supporting assets, underestimating personal goodwill, underestimating the risks to an outsider, and underestimating time to clean up. If you're selling shares, you really should consult your accountant in good time. There's a kind of 2-year window that the tax department looks for, and so I'm suggesting have a chat with your accountant more than 2 months, more than 2 years ahead of the time you want to sell, because there are tax considerations. And this is primarily in the lifetime capital gains exemption. And again, this is a topic for you to talk to your accountants about. It can make a big difference to the net amount you take at the end of the day. Partial sales, where you just bring in the minority shareholders. The only real point that I want to make here is that if you're doing that, you should bring in, or you should introduce a shareholders agreement and get that signed at the date you bring in the new shareholders. It'll save an awful amount of trouble later on. Farming, the only real point I want to make here is farming is a very specialized business. A chartered business valuator is not necessarily the best advisor on value. Most of the value is usually taken up in the value of the land. And if you have a farm and you're considering selling the farm, I would suggest that the best starting point is an agricultural consultant or a farm appraiser. And I'm sorry I've probably run over a little bit, but if there are any more questions, I'd be happy to deal with those. I've got my contact details on the slide that's up now. And so, you know, if anyone is welcome to connect with me. And I see another question has come in. Question of valuing goodwill. You know, goodwill is, at the end of the day, is a matter of judgment. My response to this question, which is that are the same legal issues involved with valuing goodwill, which might apply to overestimating assets on a sale. A person buying a business is obligated to carry out their own due diligence. And that due diligence could include getting their own third-party valuation done on the business. They may well come up with a different value for goodwill. And that would then become a point for negotiating in arriving at the final selling price. So I don't think there should be any legal implications. A lot of it will depend on what is put into the sale agreement. If you guarantee that the goodwill is at a certain level, I think you are setting yourself up for a legal suit if it doesn't turn out right. But I think, you know, a sale agreement should always incorporate a clause that indicates the buyer has done their own due diligence. The buyer should assume that any information they're given should be able to withstand any kind of testing. And so the same would apply to goodwill. Any other questions?
I don't see any questions coming in, but Paul, as always, you do a fantastic job on breaking down such an important topic. And on behalf of Succession Matching and all of our community partners, just thank you so much for taking your time. And thank you to everyone that joined in on the webinar. You can see Paul's information there. Please give him a call. I know, Paul, you don't like to toot your own horn, but I also know that your first consultation is also free. So make sure you pick up the phone and call Paul if you have any questions. So thank you very much for today.
My pleasure. Okay.